A mortgage looks like plain debt, but the borrower controls an option. If rates fall, refinancing can cut the payment on a $500,000 loan from about $2,998 to about $2,533. If rates rise, the borrower just keeps the old cheap loan. The investor does not control the best part of the payoff. From the borrower side, this is a liability. From the investor side, it is a stream of principal and interest cash flows. Those payments can be pooled into MBS, but the stream can end early. If the borrower prepays or refinances, the old high-coupon cash flows disappear. That is why the investor is short the prepayment option. This option matters at market scale. The Fed reported about $2.3 trillion of agency MBS holdings in June 2024, almost 30% of the market. That implies roughly $7.7 trillion outstanding. SIFMA also shows heavy daily trading. This is major fixed income market plumbing, not a niche footnote. Start with the clean baseline. For a normal fixed-rate bond, lower yields make the old coupon stream more valuable. Higher yields make it less valuable. The curve is not straight. It bends in the investor's favor. That is the positive convexity mortgage investors would like to keep. Now, price the mortgage with no prepayment. On $100 of par at 6%, the scheduled monthly payment is about 0.599551. Discount all 360 payments, and the value is $100 at a 6% market rate, about $125.58 at 4%, and about $81.71 at 8%. That is normal bond math. Now add the borrower option. When market rates fall, the investor wants to keep the old 6% payments. The borrower wants the opposite. They refinance, the old loan pays off, and the rich cash flows vanish. So the no prepayment upside gets capped near par in this toy geometry. The exact cap is model-driven, but the shape is the point. This is negative convexity. When rates fall, prepayments speed up and duration shortens, right when investors would rather own a longer high-coupon asset. When rates rise, refinancing slows and duration extends. The curve bends against the investor, shorter on the way down, longer on the way up. The option is real, but it is not magic, and it is not free. Mortgage rates already include compensation for prepayment risk, servicing, guarantee fees, and market spreads. Borrowers also face costs, paperwork, and inertia. That is why real desks use prepayment models, not one simple refinance trigger. The Fed portfolio is a clean, real-world anchor. More than 90% of its agency MBS holdings had passed through coupons below 4% in June 2024. In a higher rate market, those loans are out of the money to refinance. Borrowers keep the low-rate mortgage, pay down slow, and expected life extends. Here is the framework. When rates fall, the borrower can refinance and the investor loses upside. When rates rise, the borrower keeps the cheap mortgage and the investor takes extension risk. So an MBS is not just rates. It is rates plus borrower behavior, or roughly a bond minus the borrower's prepayment option. That is the mental model to keep. A mortgage is scheduled debt cash flows plus a borrower-controlled choice about when those cash flows stop. For the homeowner, that option can be valuable. For the investor, it creates capped upside, extension risk, and behavior-driven duration. Mortgage markets are not just about credit. They are also about options. This is Quantly, the math behind every market.